Hi traders, welcome to How to Profit by Trading Options in Volatile Markets. My name is Gregg Killpack. I run the options desk at the Traders Plan. I'm really excited to share with you a strategy that's currently working really well in the current market environment. When I talk about how to profit by trading options in volatile markets, we could just as easily say bear markets or down markets. And I'm excited to share with you this strategy that has been working so well for us this year. This is a strategy that works well whether the stock or the market is trending up or down. So I'm looking forward to sharing that with you. Any experienced trader who's been consistently profitable in the past, but maybe not so much this year, will do very well by paying attention to this entire presentation. So go ahead and turn off all distractions and let's get to it. Now let's make the lawyers happy starting off. So let's get the disclosure out of the way. This presentation is for educational purposes only. This is not a recommendation or solicitation to buy or sell securities. You're responsible for your own trading decisions. Always do your own research before investing in any securities. And I'm not going to read this whole thing. Go ahead and press the print screen button so you can have this for future reference. And I'll give you a few seconds to read through this. Okay, very good. I have tremendous respect for Larry Williams, who is an author and a distinguished trader. He's also the all-time record holder of the Robbins Futures trading competition. In 1 year, he turned $10,000 into over $1.1 million, which is crazy. He's blown that record away, and no one's come close since then. He said that some people think trading stocks is a game of knowing the future, of knowing that which cannot be known. It is not. Excuse me. It is not. This is a game of developing strategies with winning advantages, getting the odds on your side, working those odds, and staying alert to any potential changes in the game. Larry Williams is great, and he's absolutely right in what he said here. So this is what the market has been like over the last 12 months or so. Up until the end of last year, the market was really in an uptrend still. And you can see in the left half of this chart that the market was showing normal volatility. And, you know, there's still pretty good volatility there. There are up moves and down moves in the markets. But you can see easily on the right half of the chart, as the market started to roll over, that the swings up and down are bigger. So that means we have to adjust our trading style and how we do things. Two main things you have to know about that is generally you want to limit or lower your account size, your trade size, your position size, because these swings are bigger. You're taking more risk anytime you enter a position. And second off, we really want to be as exact as we can and careful on our entry points. So that's the takeaway from this. And you can see that increased volatility, which I'm sure you're already aware of in the markets. The point I want to make to you today is that traders can make money whether the market is going up or down, and so can you. As long as the market isn't just sitting there, which it sometimes does in the summer when it's slow, as long as the stocks in the markets are trending up or down, there's money to be made. You just have to know what to look for. My promise to you today is that my favorite strategy is what I'm going to show you today and what has done so well for us over the last several months for both long and short trades. Now, I'm a swing trader, so that means I'm holding on to positions for either stocks or options for about 1 to 4 weeks. Swing lows to swing highs over the short term tends to happen in that time frame. And in this presentation, I'm going to show you my favorite entry point, as well as the profit target and the stop loss point. I'm also going to talk about some money management rules that'll help keep you risking the right amount for every trade. What makes this so easy is that these are very easy and simple chart patterns and rules to follow. And with swing trading, This is something that you can do while you work or go to school. Day traders kind of have to watch the markets during the day, all the time during market hours, if they're going to trade that. But swing traders don't. Swing traders have more of a life and get more done. So if you work or go to school, or you're busy doing something else during the day, you only have to check in from time to time to see how your trades are going. You can still do other things away from the market. You don't have to just sit there and stare at the market all the time. So why should you listen to anything that I have to say? Well, a little bit about me. I've been trading the markets for a long time. I've been trading stocks for 22 years, trading options for about 15 years, and I've been coaching other traders for the past 9 years. I've also used to work at Fidelity Investments, and I've even written a book and put it out there on Amazon, How to Triple Your Money or More Every Decade for Long-Term Investors. So I know a little bit about what I'm talking about. So the key to success, in my opinion, is focus. I only trade stocks and options. I don't trade, and I don't need to trade bonds, futures, Forex, crypto, or anything else. I like to stay focused because I would much rather be very good and very knowledgeable about one or two things rather than be a jack of all trades and master of none. And so for me, trading stocks and options is all I focus on. And I like to do only swing trades. I don't do day trades very much anymore. So like I said, I'm a swing trader. I do stocks and options, and the duration for my trades is about 1 to 4 weeks. Now it can be less than that, or it can be a little bit more than that. I'm fine with that as long as the position is moving in my direction. But most of the time, you're going to catch a swing low to a swing high, or vice versa, within about 1 to 4 weeks. So let's talk about what does not work in a bear market unless you have really exceptional timing. Well, buying stocks or calls or bonds or futures, or pretty much buying anything in the expectation that it'll go up, it's going to be harder, obviously, to make a profit in your trade if the market is overall going down. And it pretty much is going down for all of the securities, bonds, stocks, options, and futures. So you really have to have a good sense of timing or a system that works well in order to make a profit in your trading in the current market environment. So the ways that I profit in bear markets, and that anyone can profit, is to sell short the stocks or to buy put options. Now, when you buy put options, that actually works as a hedge if you still are holding stocks in long-term accounts, like a retirement account. And so you can have gains in your put options as kind of a way to offset losses that might occur in your long-term positions. So that's just one way of thinking about buying put options. If you want to have income, you can also sell call options and do credit spreads. These are the 3 best ways I know to actually make money in bear markets versus, long-term buy and hold and losing money in the markets. So as I pointed out in the chart earlier, bear markets are more volatile. And so we want to trade smaller, and we have to wait for the very best entry points. We have to be patient and disciplined, 2 of the most important characteristics that traders need to have to be successful. One of the things that I really like, though, about bear markets is that in general, stocks fall faster than they climb. And so if you catch the trades just right when a stock is going to roll over, you can make big profits really fast. And I really like that when I can catch a trade where a stock just falls off a cliff and I make a lot of money fast on my put options. So let's get into the strategy. Now, this strategy is what it looks like when stocks are trending up. So we've got American Express, and this is last year in 2021. We've got a daily chart with the 50-day moving average going up. That's the purple line there. And then we've got a pullback. This is buying the pullback strategy, and it's a well-known strategy. Let me show you how I do it. You've got a swing high early in the chart around the 20th of January. The stock pulls back for about a week. And then finally, you've got an entry point when the green candle goes above the red candle and stays there. That's your sign that the downtrend, the pullback is over and the uptrend is going to follow through. The assumption here is that the stock is going to follow through to the upside. Most of the time it does that. And so this is a very good entry spot with low risk to enter the position, whether you're buying the stock or buying calls. Now, generally I'm doing options, so I'm buying calls here. The entry point would have been at a price around 118, and the stop is all the way below the low of the previous day. And you see that the stock actually went down for a day or two, but quickly snapped back up and had a very nice follow through. So we caught this when the stock was trading at 118, and we held on until it went down at 136, the second down day. Now I'll show you the rules for this in just a second, but the reward versus risk on this turned out to be 3-to-1, which is great. Anytime we're making a profit of 3 times the risk, or at least twice the risk, we're doing really well. And you can see that the distance all the way up to the top where we locked in our profits is a lot bigger a distance. It's $18 away compared to the $6 risk that we took. Now I am talking in terms of the price of the stock because I don't have any way of going back and looking at the price of the option at the time. But still, it's the same for options. You're going to make a much bigger profit compared to how much you're risking by setting up your trades in this way. So here's a chart of ExxonMobil, and we see the same sort of pattern. The stock is in an uptrend. It pulls back for 2 to 3 weeks here. And then we've got an entry point at the circled area. Now, why is that the entry point? Well, that's where I saw the stock, and the stock in the left candle day in the circled area, that's a green candle, that's an inside day, but that's not your signal. The signal is when the stock trades and is ready to close above the trading range of the previous day. Okay, so that shows us a really good entry point. And sometimes when you enter right here, the stock goes straight up to where you want it to go, and sometimes it doesn't. Like the other chart, it pulls back a little bit, but then follows through. So on this, we entered at about 77.50 with a stop around 74. Now, the stock went up. You see that red candle in the middle of the uptrend between the entry and the exit. Even though that's a red candle, I'm not concerned about that because it's trading above the range of the previous day. So no big deal. And again, on that first red candle the day before the exit, that is showing us, it could have kept going up after that, but I'm convinced that the uptrend is over, at least for the swing high on the second day, and that's where we exited. Now, it pulled back pretty hard on that second day, which cut into our profits, but we still made a very nice profit of $200 per contract on this trade. What we're looking for is not to necessarily maximize the exact low and get out at the exact high, because that's guessing. We want to stay in the trade as long as the stock is going in our direction. And we're going to let the stock show us when it's not going in our direction anymore. And that's what we get at the exit. So let me give you the rules on this. This is for stocks that are in an uptrend. You want the 50-day moving average on a daily chart, just a simple moving average, 50-day, to be going up. And you can see that on the chart on the purple line. It's just going up over time. So if you have any question about if the stock is trending up or not, you just look at this simple 50-day moving average. It's crystal clear if it's in an uptrend or not. Then we want to see a pullback of at least 5% going over 1 to 3 weeks. We don't want to say a 1 or 2 day pullback. We want it to be at least 1 full week. So going back to the chart, we see that the high came on the swing high on February 7th, and then the swing low happened here around February 23rd, 2 to 3 weeks away. And the pullback went from about 83 all the way below 75. So that's easily 5% pullback. And then where's the entry point? It's when the stock trades above the high of the previous day for at least 2 hours. Why is that? Well, because sometimes they do head fakes, is what I call it, where the stock will go up, it'll quickly come right back down intraday. You know, I'm pretty much watching the markets all the time during the day because I like it and it's my job. But we don't want to get tricked in just because the stock goes up briefly and then comes right back down. I want to see that it's holding its value up there, showing me that the uptrend is going to continue, likely to continue from there. So that's my entry point. You want to see it holding its value above the high of the previous day. And we see that on the second day, the green candle, it's closing above the highest price of the previous day. That's an excellent indicator that it's going to keep going up. Now, anytime you enter a trade, there are 2 places that you want to expect to get out. One is if it hits your profit target. And we're going to just let the stock go up and show us where the profit target is. We're going to exit when the stock is about to close below the low of the previous 2 days, just so that we don't get stopped out too early. We're going to try to maximize our profits, but we're not going to get the exact high of the price of the swing high because we want to have the stock show us it's starting to come back down, and so we need to lock in our profits. That'll help us stay in the trade as long as it's going up until it shows us it's not going up anymore. Now, when we enter a trade, unfortunately, not all trades work out. And so we're going to have a stop loss, and we're going to exit if the stock, initial exit, if the stock trades below the swing low of the previous day. So for example, or the swing low is actually 2 days before. So our entry was on that second green candle. Our swing low is down below the low of the red candle there, around 74, 74.50, whatever the low price is of that candle. If it goes down there and stays down there, it's time to exit. It's going the wrong direction. Now, like I said, sometimes it'll snap back, we'll go down there and snap back up intraday. That's actually a pretty good sign if it does that. But if it stays down there, that's trouble. We got to get out. So those are the rules for a stock that's in an uptrend. So here's what it looks like. You've got a chart of Caterpillar, and the stock makes a swing high at about $200 a share. And over a 2 to 3 week period, it goes to 180. That's about a 10% pullback there. And for the next, after it hits that swing low of 180, it goes sideways essentially for 3 days. But you can see it's trying to push the upside a little bit. We don't have confirmation of that though until the entry day, because then it's going up. It's already showing that it's starting to nibble to the upside. But it's clearly going up from there on a strong day. So I would have gotten into this trade around 186, 187 when the stock is right there. And that would have been a beautiful entry point. In fact, we did this trade, so it was a beautiful entry point. And it went up. Now, I want to show you that we exited up here at 216 because the stock closed and was headed to, about ready to close below the low of the previous day. So we actually, before the stock actually closes, we're going to exit and get out because we don't need to hold on to the next day, which might go lower. So we're going to get out near the end of the day, sometime in the afternoon, maybe about an hour before the close on the exit day. So for this trade, we actually risked about $6 per share, and then we made $30 on the trade. And the reward versus the risk turned out to be 5-to-1. Now, I want to point out one thing here. Why did we not get out on that red candle in the middle of the trade that's circled there? It says does not close, that candle does not close below the low of the previous 2 days, although it did go below briefly. It snapped back up like I was telling you about. And so that was not our exit signal. It's when it's going to close below the trading range of the previous 2 days. And clearly that got us a much bigger profit up here around 216. So very nice trade. You can see the stock's in an uptrend. You've got the 50-day moving average. You've got the at least 5% pullback over 1 to 3 weeks. And then you see the entry signal when the stock is starting to go up, telling us the uptrend is likely to continue. Now, it turns out that this exact strategy works great in a down market. This is the rules for a stock or a market that's in a downtrend. And it's actually an exact vertical mirror image of the strategy I just showed you, except for it's going down. And this is the strategy that I have used that has worked so well this year. We want a 50-day moving average, again, a simple moving average that's going down. If you have any question whether the stock is actually going down or not, stocks can, sometimes be very choppy, and that makes it real clear for you that the stock is in a downtrend, looking at the 50-day moving average. We want to see the stock bounce up at least 5% over 1 to 3 weeks. Occasionally, you will see it bounce up for a day or two. That's not what I want to see. I want to see a prolonged bounce that then starts to roll over and come back down. And we're assuming the downtrend is going to continue. And that's what this trade is about. Our entry point is when the stock trades below the range low of the previous day for at least 2 hours. The profit target is when the stock, we're going to exit when the 30 minutes before the stock closes above the high of the previous 2 days. In other words, it's starting to bounce back up again. We want to get out. The initial stop loss is we're going to exit if the stock trades above the swing high. So let me show you what that looks like on the charts. Now, this is the opposite of the previous charts that I've showed you. I call this shorting the bounce. Apple is in a downtrend, although you can't see that real well on the months before you see on this chart. You've got the 50-day moving average is declining, and it's easy to spot that. But look at how crystal clear and obvious this is. Apple goes up starting on March 15th for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, over 2 weeks, about 2.5 weeks. And then suddenly, after like over 10 green candles in a row, you see one red candle that does an intraday high, swing high, on the day before our entry point. Now, it sure looks like it's due for the swing high to be put in, but we're not sure yet. Our entry point is on the circled day when the stock goes below the low of the previous day, and it stays there for at least a couple hours. That tells us that this is likely to follow through, because it could go below the low of the previous day and snap back up. In fact, it kind of did that a couple days later. But we put our stop loss at the swing high, which means our entry point was about 177, and our stop was at 180 in terms of stock price. Now, I do options on this. So just to let you know, we'll talk more about this in a minute, but I buy an at-the-money put at least 2 months out every time. So it's an easy rule to follow. But the stock was at about 177 when I entered the trade. The exit that we got out was 169. And it's right here, the circled area, although I didn't list it as the exit. That's where the stock appears to be bouncing right off of the 50-day moving average. I don't know what's going to happen after that candle, but it's showing me it's going back up and it's holding its value. It didn't go up to 170 and then snap right back down. It held its value and stayed above 170. And so that's when it's crystal clear it's time to get out. And I could see that it was going to stay up there about an hour or two before the stock market closed. And so I knew it was time to get out. And we locked in a profit on the options of $650 per contract. Now, if you have a small account size, then you probably can only do one contract. But we have some traders who have large accounts and they're doing 3, 5, 10 contracts, and they're doing very well with this strategy. So if you had 10 contracts, this would be $6,500 profit on this trade. Let's look at what it looks like on another stock at another time. Now, this is Rivian Automotive, and we can see that it had a swing low early in the chart, and it bounced up over a 2-week period. It bounced from about $35 a share all the way to above 50. That's easily more than 5% over about a 2.5-week period once again. Now, a couple things I want to show you about this chart. First off, before the intraday, 1, 2, 3 days before that, we've got a red candle. That red candle did not close below the low of the range of the previous 2 days, but it did go below the low of the range of the previous 2 days. That's not our entry signal. It has to close down there, showing that the sellers are maintaining their strength over the buyers. And if we had entered there, we would have gotten slammed the very next day. But the stock topped out 2 days later, and we got our entry signal the second day when the stock traded below the low of the previous day, and we could for at least 2 hours. So our entry on this was right around $51 per share. We bought, again, an out the money put at least 2 months out. And then we got out about a month later when the stock traded at 34. And we made a nice $1,170 profit per contract for a $17 move over a 1-month period. That was a very good trade. Let me show you something in this sideways channel that I want to point out to you that's important as far as position management. The stock did go sideways for about 1 week, 5 trading days, but it never closed above the high of the range, above the high of the previous day's range. We got a green candle on the third day where it traded above the high, the closing price of the previous day, but not above the high price of the previous day. That kept us in the trade. Okay, so we held on to this, and this is all, we're holding on to this on the short position, and where it shows us that we're going to get out is right here in the circled area at $34 a share. Of course, I didn't know it was going to drop over the next few days, but we followed the rules of the program, and we made a very nice profit over a little over a month. And that's how you do it. Let's go over another chart here. Now, this is actually an earlier chart for Rivian. This is when back in January, where Rivian was still over $100 a share. And we got into this trade when Rivian was trading at 101. Why? Because we got the entry signal. The stock is in a downtrend. Rivian had IPO'd just a few weeks earlier, up around 150. So even though we don't have 50 days worth of days and candles to create a 50-day moving average, which that doesn't start until end of January on the 21st, clearly the stock is in a downtrend. Okay, the stock is trading and closing below the low of the previous day, showing that the downtrend is going to continue. So we entered right there. The stock bounced up. It went down pretty hard, down to 80, which is a 20% move in a week. and then it bounced up a couple of days later. So we got out at 87, and yeah, we should have, or I don't remember if we did get in a few days later on this or not. But for this trade, we logged in a $650 profit per contract, which was beautiful. And once again, we're buying at the money puts at least 2 months out. And since we, registered our profit and got out within a week, we didn't get hit very hard at all for the time value. We go 2 months out because the time value decay happens most often, and as much of the time decay happens in the last month. We're only planning on holding on our trades for about a month at the most, usually. And so we're not going to get hit that hard by the time decay, which happens mostly in the last month of trading. And so we made a very nice profit on this trade. Legendary trader Jesse Livermore said that if a stock doesn't act right, you don't touch it, because being unable to tell precisely what is wrong, you cannot tell which way it is going. No diagnosis, no prognosis, no prognosis, no profit. He's absolutely right on that. Going back to the chart, we are letting the chart show us where the stock is going. We've got the stock in a downtrend, in a long-term downtrend. We've got some kind of bounce that happened previous to what you can see on this chart. And then the stock is starting to make new lows by closing below the trading range of the previous day. That's the entry signal. And most of the time, it's a beautiful entry signal. We always want to set up our trades so that we only risk losing a little when we're wrong, but making a lot when we're right. So on this trade, if it had actually gone up above the swing high, it would have been up around 107 or so. We got in around 101. So that's risking about $6 a share to make what ended up to be $14 a share in terms of the stock price. So the profit target should always be further away compared to your stop loss, which tells you when you need to get out. We have a stop loss like this because if it closes up higher, that's telling us that the stock is starting to trend in the wrong direction. And so that's how you set up these trades, and it works great, whether you're swing trading stocks or options. Jesse Livermore also said, the price pattern reminds you that every movement of importance is but a repetition of similar price movements, that just as soon as you can familiarize yourself with the actions of the past, you will be able to anticipate and act correctly and profitably upon forthcoming movements, because nothing really new really happens in the markets. The same thing has been happened over and over for 200 plus years, for as long as the markets have been open. And so if you can teach yourself to spot these patterns that I'm showing you, whether the market is going up or down, then you have a way to make money and to profit from your trading for the rest of your life. You know, you can do this without me, and that's the goal here. Let's talk a little bit about risk management. Risk is about 50% on the option. We don't hold on to the trade until we lose all the cost of the option. We're generally risking about half the cost of the option. So for example, if the option costs $400, I don't plan on losing $400. The most I usually could lose on any trade is half, which would be $200. So we're going to limit risk by doing that. And if the trade doesn't work out within a reasonable amount of time, it doesn't start to work out within a week or two, usually I'll wait at least 2 weeks. And the trade better start to work out pretty soon or I'm out. And I'm gonna, keep most of the value of the trade of the option and get it back with a small loss and move on to the next trade. Now, if you have a small account size, let's say under $5,000, you can lower your risk by buying options on stocks that are under $100. If you have a very small account, you'll want to do it options on stocks that are under $50. But if you are trying to do a trade with a limited account on Tesla that has, is worth several $100s, an at the money put 2 months out to expiration when Tesla was priced at $700 would cost you $8,000. You'd be risking half that, which is $4,000. That's a pretty big chunk of change for an options trade. So unless you have a pretty sizable account with good experience, that's probably the trade you want to stay away from. However, if you're doing the trade on Starbucks with this same pattern, well, an at the money put 2 months out for Starbucks when it was at $75 a share was just $400, much more able to do a trade like that. So let's talk about money management rules. You've got a $10,000 account. Generally, it's appropriate to risk 2 to 3% on any one trade. Now, once again, that's not the cost of the option. That's half the cost of the option, the amount that we're actually risking that we might lose if the trade doesn't work out. So we're going to buy options in the range of $400 to $600, and we're going to risk losing about half that. But our winners are going to average being somewhere typically between 2 and 5 times the amount that we risked. On rare occasion, I've even made 10 times the amount risked because you get a lot of leverage from trading options. And if a stock really moves after you enter the trade, you can do very well. But the options, the risk is limited, and that's what you need for good trading, to limit your risk. So let's talk about reasonable expectations for profits. For on a $10,000 account, if we were to do 10 trades, which might last, depending on how active a trader you are, you're going to get that within 1 to 3 months. Basically, for me, it's probably under 2 months. In that time, we're going to have 5 winners. Let's say we're as low as 50% winning trades. Let's say we have 5 winners where the profit is going to be at least twice what we're risking. So the winners would be $600 for a total profit of $3,000 minus the losers. We had 5 losers risking as much as half, which is usually less than that, honestly, but sometimes it's as much as half. So we'd be risking as much as $1,500. So even if you're only right half the time, and again, we should be able to do better than that, then your profit is, you're still going to make a profit consistently of around $1,500 based on this scenario. I want to tell you my actual trade performance on the trade alerts that I've given since I've been at the Traders Plan and started doing these option alerts starting last October. I have a win rate of 55%. And I think it's actually a little bit higher than that, including my last couple of trades that I didn't add to this calculation. But my P&L over the last 6 to 7 months is $4,200, which is 42% on a $10,000 account for, again, swing trading with a duration of 1 to 4 week hold time on our trades. That sure beats the heck out of losing 20% buy and hold in the markets. Very nice. And, we're consistently making money and making a profit in our trades, doing options. And that's how it works. You want to go with the trend. Now, I do option trade alerts with the Traders Plan. We do 2 alerts each week on average. We generally buy calls and puts outright. It's very simple. I keep it simple. I really like to keep it that way because most of our traders are learning how to trade. We sometimes do debit spreads, which simply means that we're lowering the cost of buying the calls or puts. And occasionally we do credit spreads as well. Some people, sometimes I do that, but in the current market, I actually prefer the previous 3, buying calls, puts, and doing debit spreads. We have a members area where we offer many educational videos on how to trade options. And again, we have a win rate of 55% or better with a profit ratio of averaging 2 to 5 times the amount that we risked. These are some of the things that people have said about working with me. Gregg makes trading options as easy as it could be. He keeps it simple and profitable. He's available to answer questions via email. He's always amiable and helpful. Gregg's teaching style is backed up by years of internal research, and you can tell he provided solid advice to me prior to this recent market correction, which ended up saving me hundreds of thousands of dollars. Jim in LA is a big trader, and I was able to help him save a lot of money in his trading by following my advice. So I've been doing this for a long time, and I can help you as well. Now, what we're offering in this package is the Options Accelerator program, which has a value of $9.97, and the Options Income Alerts. And like I said, I usually do about 2 trades per week, but I show you and explain why I'm doing the trades. And you can learn to do this on your own, so you don't need me anymore. That's actually the ultimate value of what I'm trying to accomplish here. We want our traders to get so good at this that they don't need us anymore, and they can and graduate and profitably trade for the rest of their lives. That's the ideal thing. You know, 22 years ago, when I was really learning how to trade, I wanted so bad to have a mentor, to have someone who's been there, who could help me understand what was going on. I didn't have that. I had to figure this out on my own. So I'm doing my best to be there for you, to help you make money and make a profit in your trading. Now, we're offering several things for great value in this package. As a special bonus, you'll receive access to one of our top performing trading systems, the weekly reversal system. We're going to show you how to buy high quality stocks on a pullback. And by the way, this system has made a profit 75% of the time year to date in 2022, buying stocks. Stephen has an excellent strategy, the weekly reversal system, that has done really well catching the bounces this year. And we're going to do a live workshop July 26th and 27th. And we're going to have small group classes live, so you can ask questions and learn in person. So this is a free admission for joining now. So in this offer, you're going to get the Options Accelerator program that teaches you how to trade the options, as well as my weekly income option alerts. We'll give you the weekly reversal workshop to teach you the weekly reversal strategy and the weekly reversal option system, so you can trade it with stocks or options. The total value on what we have sold this in the past is a total value of approaching $3,000, $29.88. But we're not going to charge that today. So if all this did for you was to give you additional retirement income, would it be worth it? If it financed a few vacation trips on your bucket list each year, would it be worth it to you to spend a little money for your education? If this allowed you to retire more comfortably than you and your family thought possible, would it be worth a small price for the education? We're going to offer this Options Accelerator program with all the bonuses I just mentioned for just $297 per quarter. You can order by going to this site below. That's plan.thetraders.com/checkout-options-income, which you can see at the area below. This is a great value for learning, for education. We really want to teach you how to fish. You know, the old saying, you can give someone a fish for a day and feed them, or you can teach them how to fish and feed them for a lifetime. We're definitely trying to show you and to teach you how to trade for the rest of your life. Can you imagine how that's going to affect your life by learning how to do this and making consistent profits from the markets, whether the market is going up or down? That's huge. And having the alerts given to you every week, that's awesome. Now, we're so confident in our trading systems that we have a guarantee. We will allow you to trade it for 30 days. And if for any reason it's not for you, you can request a full refund. Now, there's just one caveat to that. You must prove that you've taken at least one trade. We want to see that you're really trying. But if you try, we know this works because you're doing the same thing we're doing, and we're consistently profitable in our trading. And we know that you can be too. All you have to do is do what we're doing and show you the trades that we're doing, and you can learn how to do this. So this is the whole program. You can order once again at the website above, listed there. And you've got the options accelerator program, the options incomes alerts, the weekly reversal workshop that you can use actually for stocks or for options, and the weekly reversal options system. So you've got the daily and the weekly alerts for both stocks and options. Very great value for what we're asking for this. Just $297 a quarter. Now, in addition, something that is not listed here that we also offer is I've been a trading coach for 9 years. I also offer, if you sign up today only, I'll offer a 1-hour free Zoom call to go one-on-one to talk about your trading. I'm really good at spotting mistakes that traders make, and usually I can cut right through it in one session. And so sign up today and I'll give you a 1-hour Zoom trading session for free as a bonus, in addition to all these other things that we're offering. So my email is on the order form. Go to this order form if you want my email, and you can email me with any questions about the program or questions about anything. I'll be happy to talk with you about that. My email address, once again, it's on the order form, but it's Gregg@TheTradersPlan.com. That's Gregg. I have 2 G's at the end of my name, @TheTradersPlan.com. So that's the offer, and that's the system that we trade. And yeah, things are going really well. So let's go to some of the questions now that I see in the chat. Okay. Someone said time decay would eat that up in a week. Well, no, that's not true. Not if you buy 2 months out or longer. Now, if you buy a week out, yeah, that would be true, but that's not. So yeah, that wouldn't be a problem. The time decay would be minimal for 1 week in an option that's at least 2 months out. Now we've got another question here going on a slide going way back. I'll refer back to that. How come it is $650 profit when 14 points are made? Well, actually, because it was a debit spread. When you do a debit spread, what that means is you're limiting your risk, but you're also limiting your profit on the trade. When you do a debit spread on a bearish position, let's say a stock is at $100 a share, you would buy 100 strike price put going out at least 2 months. And then to offset the cost of that trade, you're going to get maybe half the value of that option back by selling an option down around 90 or 85. And so that's how that works. So you're right. If I had bought the put outright, I would have made over $1,000 on that trade. But we actually did a debit spread to lower the cost of the trade because of a higher price stock. So let's look through some more questions here and talk about that. So should we only be trading puts right now? That's a very good question. The answer is no. Mostly it will be puts because most stocks are trending down right now. But if you find a stock that's trending up, by all means, you can play the upside. Now, most stocks are going to trade in the direction of the overall market. So I would, most of the time you're going to probably be choosing puts to trade the downside. But you can certainly, trade the upside with calls when you see a bounce or a stock that's trending up. Let's see, can we use this strategy for day trading rather than swing trading with $1,000 account? I think that stands for. I guess you could, but the strategy is set up for swing trading. So I don't actually know how well this would work for day trading. I suppose there might be a way to do it for day trading, but I haven't, looked into that, so I wouldn't encourage that. I don't use it for that purpose. When do you set your stop loss? Well, as soon as you enter the position, you already know where your stop loss is because it's above the swing high for stocks that are trending down, or for stocks that are trending up below the swing low. You already see what the stop loss is going to be. Do we have to install indicators? The only indicator I use for this, which makes it so easy, is the 50-day moving average on a daily chart, going back at least 3 months. Give at least 3 months to look at the chart, and then put on the 50-day moving average. Very simple. Any charting software is going to have that. Oh, good question. How do you select stocks? I'm going to select stocks that are in the price range that I can handle. So like I said, if I have a stock that's $100 a share, well, that's fine. But if I have a small account, then I'm going to look for stocks that are around $50 a share. And I am looking for stocks that fit this pattern, the criteria. For example, a stock that's trending down, bounces up at least 5% for 1 to 3 weeks. And then I look carefully watching for the entry point. So really, I'm looking through stocks and looking at chart patterns. That's really what I look at. I don't have just one set of stocks that I trade. I have a big watch list and look at chart patterns. And when I see a chart pattern that's starting to, follow this same pattern, I watch it very carefully until I see the entry point. Then I pounce all over it. I'm basically stalking my trade like a hunter. But you mentioned an arrow. Where does the arrow come from? An arrow. Not sure what you mean by that. You want to clarify that with a question? You mentioned an arrow. So anyway, this strategy has worked so well in up and down markets. You just adjust the strategy to fit your situation. So if you're a new trader, this is the right place to be to learn how to trade. If you have a small account size, we specialize in that. We help new traders learn how to trade safely at the options at thetradersplan.com. We teach you how to trade options. Okay, I think that's all for now. My time is just about up. We'll give you a few minutes to use the restroom, and I'll answer one last question. What's the minimum capital? Well, really, I think it's best to have at least $2,000. That's what I would consider a minimum. Of course, more is better, give you more room to trade in your account. But I know some traders that have done just fine with at least $2,000. I mean, you can do it with less than that. You could do it with $1,000, but your risk is a lot higher than 3% of your account size for the trades that you need to do. And also, you would need to trade, much smaller stocks, price stocks like $40, $30 per share, that sort of thing. I'd be more comfortable with at least $2,000. Okay, so that's all I've got for now. Thank you so much for being here with us, and make sure you sign up right now and get all the bonuses that we've talked about in this presentation. Go to plan.thetradersplan.com/checkout-options-income. Thanks everyone for being here, And this is Gregg Killpack signing off. Back to you.